Thanks for joining us today on The Close. I'm Morella Fernandez. Markets close in 30 minutes, and it's going to be a busy day. Let's check first where the markets are right now. The TSX Composite up 334 points, or over 1%, on news of that ceasefire agreement between Iran, the U.S., and Israel. Let's go south of the border, where the U.S. markets are also on a tear. 146-point move for the S&P, or 2.2% up on the day. The Dow Jones 2.5% up. That's over 1,000 points gained. And the Nasdaq a 537-point move up, or 2.4%. A quick look at oil. West Texas Intermediate for the May contract is down, of course, now that news that the Strait of Hormuz could open. I say could because we're not sure yet what had happened. It's down 14.5%, or $16.45 to $96.50. Quick look at gold as well. Gold futures for June up 1.1%, or $52.50 to $47.37. All right, we'll give you the latest in the market reaction to the ceasefire, but let's get to some of the other stories we're following in the BNN Bloomberg newsroom. Iran's parliamentary speaker says the U.S. has already violated that ceasefire agreement. In a post on X, Mohammed Bahar Halibaf says 3 clauses of the proposal have been violated even before negotiations really began. He cited Israel's continued attacks on Lebanon, the entry of a drone into Iranian airspace, and the denial of Iran's right to enrich uranium. He also added that a bilateral ceasefire is unreasonable. That ceasefire agreement was only announced last night. Shares of Blackline Safety surging after the Alberta-based company agreed to be taken private by investment firm Francisco Partners. The deal worth $850 million. Francisco will pay $9 a share in cash. Blackline develops wireless worker safety monitoring products. The transaction expected to close later this year. And shares of Algoma Steel getting a lift. The steel producer has entered a joint venture with Rochelle to create Rochelle Algoma Defense Solutions. Rochelle is an Ontario-based defense manufacturer of smart armored vehicles. The goal is to manufacture ballistic steel for armored vehicles for Canada's defense industry. The company says the steel can also be used for other industries, including infrastructure, marine, aerospace, and security. Shares of Lundin Mining getting a boost. The Canadian miner has completed its acquisition of an additional 5% interest in the Caserones copper mine in Chile, as well as a 31% stake in the Los Helados project. The acquisitions will add an annual copper production of up to 7,000 tons, in addition to bolstering the company's copper and gold mineral resource base. So even as stocks and oil prices react to the U.S.-Iran ceasefire agreement, my next guest is focused on what comes after that, as well as the upcoming earnings season. For more on his outlook and investment ideas, let's bring in Alan Small, Senior Investment Advisor at Alan Small Financial Group, IA Private Wealth. Thanks for joining us.
Thanks for having me.
Do you think the markets are overreacting to the ceasefire agreement? I ask because, as you heard, there are already accusations that it's not really working yet.
Possibly. They are overreacting, although I think what I take out of all this, whether or not the ceasefire holds, whether or not it doesn't, I think investors that are questioning whether they should be out of the market or in the market, I think today's rally tells you that, it gives you that answer. I think you want to be in this market. I think you want to look for opportunities in this market, because when the conflict does come to some resolution, however it comes to a resolution, you're going to see a market like this, a market that rebounds and I guess makes back, if not all the losses pretty quickly that came from when the conflict started, pretty much most of them right away. And then from there, we're going to have to see where the market goes, because obviously there were some issues with the market prior to the conflict, whether it was AI disruption, whether it was, the software stocks, the tech names, whatever it was, there were a lot of issues even before we went into this conflict. So I think you're going to see a bounce back. You are seeing it today. Perhaps the bounce back maybe even isn't as strong as it could have been without these headlines that have come out over the last few hours. Maybe if those headlines didn't come out, Maybe we would see oil prices down towards $90 a barrel. So we'll have to see. But, I think the market's taking it in stride. And I think, is it overdone? Perhaps, perhaps not. I think regardless of that, I just think it tells all investors that things will bounce and bounce very quickly.
You mentioned some of the issues that were overhanging the markets ahead of this. One of them was private equity. Another was overspending on AI. People were worried about that CapEx spend. Do you think those will reemerge if this settles down as sort of the top issues again?
I think it can. And, take a name like, some of the Mag 7 names like a Meta, who were punished for all of the CapEx, for all the spend that they made. And this is why I think this upcoming earnings season is so important. When these companies report earnings, what are they going to tell us? Are they going to continue to tell us that the spend is working? Meta had, for example, great results last quarter. And actually the stock went higher because investors said they are spending a lot, but it's justified. What about other companies like Microsoft, like Amazon, some of the big cap tech names? Is the amount of money that they're spending, is it justified? And I think the earnings this season and I guess in next earnings season and earnings seasons to come, it's going to continue to give us more and more information. But definitely over the next 4 weeks, we're going to learn more about how these companies are faring. Is it overdone? Is the sell-off overdone in the software stocks and the cybersecurity names? I think it is. But these companies need to report strong earnings to get investors excited again.
Always interesting in the Canadian perspective how things shake out. So for today, for example, Aritzia has gained in double digits, which is a women's clothing retailer. And then you have Magna, which makes car parts, of course, Magna International, also moving up. So is there some sort of trend you see in the gainers today?
It's tough. I think the overall trend is that it's a risk-on day. So right now, equities right across the board in all sectors are higher. Aritzia is probably even a little bit higher than maybe what it would have been because of their latest earnings, because how much money they're making right now, how well the company is performing. Even Magna had fantastic earnings last quarter. Magna trades a lot cheaper than Aritzia. Aritzia is somewhere like 40 times forward earnings, a little bit pricey for my liking. But a name like Magna also, trading, I think 9 times current earnings, 15 times forward earnings. A name like that, still relatively cheap. And when you look at a name like Magna, will they get, be more affected by the trade and what's going on with respect to Kuzma? I'm not so sure because Magna they're so large, they have plants here in Canada that can produce for Canada, and they have plants in the U.S. They have more plants in the U.S. than they have in Canada that can produce in the United States. So you may not see that cross-border type of scenario that many other companies have to ship stuff.
So they can shift if they need to.
Exactly. And so I think Magna is in a good place. And I think it's being rewarded on a day like today where it is a risk-on day. You're seeing both those names up significantly.
Let's get to one of your stock picks, which is Constellation Software. I haven't looked at it today, but of course it's been dragging on concerns about AI taking over for software and basically the way that they've done business and whether there's a forward path for that. Why do you still like it?
It's so cheap. It's down more than 50% from the highs. You're looking today, it's up a little bit, couple of percent, as you can see. But to me, it's got a long way to go. I do believe that the AI disruption with regards to software companies in the U.S. and obviously here in Canada is overblown, is overdone. I do not believe that whatever Anthropic comes out with, whatever their plugins are going to replace these companies, these large, very large companies that have different types of businesses, doing business with many different companies. It's going to take a long time to replace what these companies are doing. Constellation Software or any of the other names like a CRM, Salesforce, or ServiceNow. These are companies that deal with the largest companies in the world, the Fortune 500 companies. Not so easy to be replaced. Now, yes, maybe going forward, they may have to restructure, rejig how they do business, but I still believe these companies will do that. The software sector as a whole is famous for rejigging business every now and again when some sort of disruption happens. So I think they're going to be just fine. It may take a little bit, but again, a name like Constellation Software, their next earnings report, what are they going to say if they continue to have strong earnings, which they did last quarter? Is the name, or are investors going to think this name is very cheap? I think they will. Okay,
let's get to one of your other stock picks, which is Celestica, which I was just looking at a year ago was at something like 79, up today to 317. And you think there's more growth ahead?
I do. And so a name like Celestica, up to 440 today. They were actually under $400 for a little while at the recent lows, trading under 30 times. I thought it was a steal. This company was over $500 a share, trading at 50 times earnings at one point in the, not so long ago. So I think the sell-off again in a name like Celestica overdone. A lot of people will, lump in Celestica with the other type, like the Mag 7 names, even though obviously it's not a Mag 7 name, not nearly as big, but they're all about AI, electronics. And that's, when you think about AI, you think about tech in Canada, that's the number one name, at least that I come to, is Celestica. And I think it's another name that already you've seen a tremendous rebound from the high threes into the mid fours right now, $4.40 a share. And I think it still has room to run higher. It's a very, very volatile name, so not for the faint of heart. If you can handle the volatility that a name like that brings, I think it's a name you can take a look at.
Yeah, and I had the American numbers just to clarify that, why we had the difference. We're going to leave it there. Good to see you. Thanks for coming in, Alan.
Thank you.
Alan Small, Senior Investment Advisor, Alan Small Financial Group, IA Private Wealth. Up next, we'll unpack Iran's 10-point peace plan. That was made with the American president and with Israel. We'll talk about that in a moment. Stay tuned. The U.S. president has referred to that 10-point ceasefire plan from Iran as a workable basis on which to negotiate. But already Iran says it's been violated. Let's go to Jonathan Panikoff on this of the Atlantic Council. Jonathan, are you surprised, first of all, the plan was even considered, as it seems to give Iran the right to enrich uranium?
Thanks for having me. Look, I think there's a couple of surprises here. One, the points that Iran put forward are actually not that different than what they had put forward a couple of weeks ago, maybe about 10 days ago. I think the question then becomes what this really was about for the U.S. and for President Trump. And I think really that's probably, he may have been looking for an off-ramp fundamentally. And so from that perspective, no, it's not a surprise. He took what he can get. And we've seen President Trump before disagree with language and frame it his own terms. The problem is where we are now is it's largely a Rorschach test. In other words, it's whatever anybody wants it to be. And so that becomes challenging in terms of whether or not it can actually hold if both sides aren't in agreement on what the terms are.
Yeah, let me take that further, because you have a third side, which is Israel, accused of attacking Lebanon, and Iran says that was a no-go. So is there just a series of disconnects here?
I think that there's some disconnects. I'm just not sure what is intentional yet and what is not. In other words, for the Israelis, did they sign off on the deal? I don't know that we fully know that. They certainly were aware of it. We then saw Iran attack Kuwait this morning. Was that about command and control, or was that actually a reflection of wanting to retaliate for a violation of the deal, holding the U.S. accountable? And for the U.S., that means holding the Gulf states accountable. I think that there's a lot of challenges. If it can survive the next 48 to 72 hours, then I think there's a reasonable chance that we do get through the full ceasefire period. But right now, I think we're in a period of what could be very quickly unintended escalation. And so if it's not contained, and both the Iranians and the U.S. don't work to try and ensure that the deal holds, then it may fall apart before Vice President Vance even gets to Islamabad on Friday.
Okay, so a reminder, this is supposed to be a 2-week period of cessation. That being said, what do you think the American expectation is of how quickly the Strait of Hormuz should open and how that's actually going to work? Because again, Iran seems to think it'll have control and they want to put tolling in place.
That's exactly right. And the reality is Iran does have de facto control right now. We saw President Trump come out earlier today with a Truth Social tweet that said something to the extent of maybe Iran and the U.S. will do a toll together. And I think that was head spinning for a lot of analysts and for, frankly, the markets as a whole in terms of how do you even interpret that as well. Look, I think the assumption was that free and safe passage meant that we would revert back to where we were before the war and that Iran would not militarize the Strait of Hormuz. Clearly, Iran is not of the same perspective, and it doesn't have any interest. And I wouldn't expect it to give up what is fundamental leverage, not just in the region, but over the entirety of the global community. We've seen the impact across sectors, not just in the energy sector, but downstream, secondary and tertiary impacts into petrochemicals, into the ag sector, into textiles. That, I think, Iran views as a positive. It gives them control, and it gives them a very big lever to play.
Okay. Let's talk about sanctions, which is another point of the plan. Iran wants sanctions removed. Some have been in place, of course, for decades. Do you see that as something that will get looked at maybe down the road, not as important? And how quickly could sanctions be removed?
I think sanctions actually largely have been about actually the nuclear program. And so I think the question is, okay, in the next 2 weeks, do you realistically think you can figure out some sort of meaningful resolution to the nuclear program, maybe taking some of the content from the negotiations that were happening last summer before the June strikes, that were happening right before this war erupted? Maybe, but I think what's probably more likely is that you have sanctions movements that are associated with eventually coming to a resolution on both the highly enriched uranium and the future of an Iranian nuclear program more holistically. The problem is right now, for a lot of the ships that are even trying to cross the strait, paying the toll that Iran is demanding is a violation of sanctions. And I spoke to folks in Dubai this morning. There just isn't clear guidance yet from the United States on how they're supposed to then interpret this and what they're supposed to do. I think the lack of clarity here is really going to cause some havoc for investors and for the markets and for those actually operating, both shipping companies, insurance companies, for a little while here until you get resolution and clarity on how to think through sanctions, what's going to be removed, what's going to be temporarily withheld, et cetera, et cetera.
Okay. This other point I want to bring up, I think, is a little pie in the sky. Iran wants reparations. I can't see Washington in any way agreeing to, in some way, give to Iran some of what it's already struck down, either in sort of money or trade or something else. Do you think this is a fair ask by Iran, and do you think Washington would in any way agree to that?
The answer is no and no. I don't think it's a fair ask. I also don't know that the Iranians think it's a fair ask. The Iranians understand how this is done. And so it's one of those, I think, points that Iran may have raised it in order to then be able to climb down for it, to have a chip to play as part of negotiations, something to give away, to be able to say, we asked for reparations, you're not giving on that, so you have to give on something else. I don't know that it's going to work or that it should work, frankly, but I think that the Iranians really do know what they're doing here, and I think they don't actually necessarily expect reparations. I think the Iranians are expecting to ensure that they have control, de facto control at least, of the Strait. That, to me, is their big priority. The second priority is making sure that the U.S. restrains Israel, which is going to be harder to do than Iran thinks, that Israel in 6 months, 9 months, 12 months doesn't come back even independently and strike again. Those, to me, are the two big asks that I think Iran wants to ensure they get at the end of the ceasefire for a permanent settlement.
All right, Jonathan Panikoff, thanks for joining us today. Got to leave it there, sir, but appreciate your time. So airlines have acutely felt the effects of the conflict in the Middle East. That's because they've been paying a lot more to fuel up their jet. Delta Airline says it's going to pay about $2 billion more. We'll talk about that in a moment. The conflict in Iran may be halted, but its impacts are still being felt across industries. Delta Airlines today says it expects to pay more than $2 billion in higher fuel costs. That outlook takes them to the end of June. Let's go to Bloomberg's George Ferguson on this. He joins us now. George, how's Delta going to come up with this money? I mean, where's it coming from?
So Delta's plan is going to be to trim back growth to 0%, flatline growth, and then they'll look to make that additional money up through higher fares, which, I mean, we think probably the broader industry needs to slow down capacity growth, probably bring it like Delta did close to zero to really try to firm up fares and compensate themselves for the higher fuel prices.
So Delta's sticking to its full year profit forecast right now, but do you think that could change?
Yeah, actually, so what I heard was that they hadn't necessarily given full year guidance. They gave 2Q guidance. And they said that the markets, especially fuel markets right now, were just too volatile to give guidance for the full year. Look, I think, today I think we're even seeing the ceasefire. We're seeing challenges with that. We're already seeing some shots fired. So my guess is that this is not the end of volatility for oil prices. They've doubled on Delta since 1Q. So I'm sure that we'll be readjusting expectations for airlines over the course of the year.
All right. So the CEO for Delta says the premium customers, the top end customers, are pretty much immune to the headlines, meaning it sounds like they'll pay for whatever they need to pay for. Do you think this is a sign that the K-shaped economy is deepening?
Yeah, I mean, I think that's about right? I think what you're going to see is Delta, American, and United will find that their premium travelers aren't going to let a 20% increase in fares get in the way of their holiday plans, and businesses won't allow it either. And so I think really what you're going to see is a fight for that lower end budget traveler. And again, that's where the market's going to have to cut some capacity. If carriers don't do it voluntarily, I think you're going to see some pain in the low cost carriers because there'll be a bunch of competition for that budget traveler.
Okay, Delta seen as a bellwether. They report a little earlier. What does it tell you about how that conflict in Iran has or is reshaping global aviation?
Yeah, so again, I think what we're going to see in the U.S. would probably be growth plans would come down for most of the carriers. Airlines like United are planning on 8 to 10% kind of seat growth in 2Q. I think they're going to have to dial that way back. One of the challenges there is going to be that part of that growth has helped these carriers lower cost per seat mile through economies of scale, and I think that's going to sort of roil that potential to lower cost per available seat mile. So again, I think they're going to have to raise fares, and capacity is going to fall. And I think you're going to see some of the weaker players in the market, airlines without as good a balance sheet, airlines like JetBlue, Spirit, Frontier, they're going to be challenged if this persists.
All right, Bloomberg's George Ferguson joining us today with the latest from Delta Airlines. Thanks for the update. A quick look at the markets before the end of the trading day. Markets on a run today. The TSX up over 1%. The S&P gaining 2.4% so far on the day, and the Nasdaq up 2.7%. Very good days with that ceasefire agreement technically still in place. We're back with the end of day numbers in just a moment. Here are the closing bells for the end of the trading day. At the Nasdaq, Daktronics ringing the closing bell. In New York, Human X ringing the bell. You're watching the close on BNN Bloomberg. I'm Marella Fernandez. Here's how we ended the day on Bay Street and Wall Street. North American markets moving up today. They are on a tear after that ceasefire agreement between Iran and the U.S. So the TSX Composite gaining 1.2% today, a 383-point move up. The S&P gaining 2.5% or 166 points. And the Nasdaq up 2.8% today. That's a 600-plus point gain on the day. A quick look at oil, which had been over $100 with the Strait of Hormuz shut to traffic, dropping today on hopes that the Strait of Hormuz will open soon. So it is down almost 15% on the day, or $16.90 to $96.05. This is West Texas for May. Let's take a look at the movers in Toronto. Aritzia, clothing retailer for women, up 9.5%. Lining up with the consumer discretionary sector being a big gainer today. Stephanie Hughes has more on that in just a moment. Materials also gaining today. So have a look at Lundin Mining. It's up 7.9%, taking share prices to $37.96. Hudbay Minerals also a gainer today of over 8%. That's a $2.50 gain per share to $32.89. Capstone Copper moving up today as well at 7.2% up, taking the share price to $11.89. And then having a look at Celestica today. It's a gainer of 7.2%, or almost $30, $29.57 to $443.10. So the energy sector, no surprise, leading in declines today, down as a whole over about 2% last I checked. Vermilion Energy dropping 7.4% or $1.45 per share. And then Parex Resources also down 9.8%, a loss of $2.69 per share. Baytex Energy also losing today 7.5%, taking the share price to $5.75. Let's bring in Bloomberg's equities reporter Stephanie Hughes for more on the day's movers. Let's start with Aritzia. Stephanie, why is it moving?
Yeah, Marella, it's a surprising, or maybe not surprising high flyer, but the exuberance behind its move higher today was pretty impressive. So those shares gained by over 11% at their highest point, which was the biggest intraday boost since October. And it was enough to help the clothing retailer recoup all of the losses it sustained since the onset of the Middle East conflict in late February. And it was also, it spent most of the time being the top TSX performer and managed to keep that momentum until the closing bells there. And so that's largely because the ceasefire news is giving a lift to a lot of the consumer discretionary names like apparel and retailers like Aritzia. But Aritzia has been particularly bolstered because of the growing investor exuberance around it and strong sales that it's been reporting over the data that it's been kind of showing over the past few months. And it's coming off a pretty strong earnings season just in January. So Aritzia has been tracking strong sales so far this year. In fact, our Bloomberg data showed a 101% increase in observable sales as of late March from a year ago, a year-over-year boost. And it was kind of an impressive, it completely led all of the peers there, retail peers, on a global sense. And I got to speak to a few analysts covering the name, like Martin Landry from Stifel. His impression was that investors were already excited about Aritzia and saw it as a high-quality name, but they were pricing in some consumer spending pressure when the Middle East conflict started, just given that there was an immediate spike in oil and gas prices. So that makes sense. If it costs more to fill up your car, you're probably spending less at a clothing store, and Aritzia, which some of its products can be at a more elevated price point sometimes. So this update has given investors a little bit more hope that that this uncertainty can be cleared up and Aritzia can continue that sales momentum growth and that growth in the U.S. that it also has been really pushing into. So you're really seeing that reflected in the share price, and that's leading up to the next earnings report that's expected to take place somewhere in either late April or early May. Hasn't been confirmed yet, but good showing today, Marella.
All right, yeah, more money for gas, less money for dresses and shoes. Okay, International Petroleum dragged down like other energy stocks. Tell me a bit more.
Yeah, so International Petroleum, those shares fell by over 10% at the lowest point today. That's completely reversing the gains that it enjoyed yesterday that actually brought it to an all-time high yesterday. I believe it was on an analyst upgrade. But that's because, like you mentioned, it just caught up in that broader oil sector sell-off because of this ceasefire news story that we've all been chasing throughout the day. And there's been a few incremental updates here and there, but for the most part, the oil and gas sector has had its damage done. So analysts mentioned that the details of the agreement are a bit murky, and as we know, things can change at any given point. But they noted that this agreement marks a meaningful step forward in finding some sort of peaceful resolution to this conflict. So it's not just International Petroleum that I'm picking on here today. It's also other names that you mentioned in the mover hits before we started talking. It's Vermilion Energy, it's Parex Resources, and a lot of other oil and gas producers. A lot of them were just taking up the bottom performers on the TSX today, Marella.
All right, Bloomberg Stephanie Hughes in Toronto. Stephanie, thank you for the update. Coming up next, U.S. stocks surged today again after the U.S. and Iran agreed to that 2-week ceasefire. More in a moment. A ceasefire agreement has lifted stocks today. My next guest says, aside from Iran, inflation is a primary headwind for equities in 2026. Let's go to Oh-Sung Kwon, Chief Equity Strategist at Wells Fargo. Thanks for joining us today.
Thanks for having me.
So, considering how many promises have come and gone on Iran, do you think investors are being a little too optimistic today?
Yeah, I mean, it was a pretty big relief rally that we saw. The market is basically saying that the war is over. But we need to think about what the ripple effect of what happened over the past month is going to be. And even before the war began, we were highlighting inflation as potentially the biggest risk of equities in 2026, more in the second half of the year. The underlying inflationary pressure is there. That's what all the soft survey has been showing over the past 2 months or so. And with Iran, that risk has obviously gone up. And that's the biggest reason why we lowered our S&P target to 7,300 from 7,800 recently. I mean, we're still bullish. We're still forecasting, close to 8% more upside for the remainder of the year. But I still think inflation is probably going to be the biggest risk to equities, and inflation data, CPI data coming out this Friday is going to be key to equities.
Okay, that being said, the numbers that come out this week are probably going to be a little bit too early to see the effects of the war, yes?
Yeah, but it's still going to show the underlying inflationary force outside of Iran. We ran a bunch of regressions using various leading indicators of inflation. And the result that we get over the next 3 to 6 months is anywhere between 3 to 4% inflation. So that's obviously well above the Fed's target and well above where we are today. So that's the risk for equities. That being said, I think ultimately, equities are going to depend on what the Fed does about it, how the Fed reacts. If the Fed is okay with, say, 3.5% or even 4% inflation, I think equities are still going to have a strong year. I mean, everything is denominated in the dollar, and that's basically the debasement trade and the run it hot and inflate out of the deficit issue that we have. It's that trade continuing, and if that's the case, I still think equities are going to have a pretty strong year this year. Okay,
you mentioned the outlook for inflation 3 to 4 months down the road. How long do you think the inflation could be a drag on stocks now that you are considering the conflict as part of that?
Yeah, I mean, like I said, I think it's ultimately the Fed. If the Fed remains pretty dovish, even with inflation at, say, 3.5%, 4%, then I think that's still bullish for equities. Everything is denominated in the dollar, and inflation means, nominal EPS is going higher, nominal GDP is going higher. And if that's the case, then equities are going higher as well. But if the Fed turns more hawkish and starts potentially thinking about hiking, then that's going to be more bearish for equities.
Okay, so what would throw off your calculation if the conflict lasted several more months?
Yeah, I mean, I think it really depends on the Fed. And there is a good chance that the Fed is okay with higher inflation because we have deficit issues. I mean, a lot of the hawks are saying that historically the Fed chose inflation over the labor market when they had to choose, especially in the 70s and 80s. But that's when debt to GDP was around 40%. Today, debt to GDP is 120%. And historically, what governments did to to solve the deficit issues is to inflate out, meaning the Fed may be okay with 3, even 4% inflation. And if that's the case, earnings are going higher because that's in nominal terms, and the S&P is probably going higher as well.
All right, Oh-Sung, I'm going to leave it there. Oh-Sung Kwon is Chief Equity Strategist, Wells Fargo. Coming up, Hyundai taking on Ford with a massive $26 billion bet on the U.S. We'll hear from the CEO in a moment. Hyundai is making a bold $26 billion push into U.S. manufacturing, including trucks and SUVs to compete with Ford. The Hyundai CEO, Jose Munoz, spoke with our Bloomberg colleagues to talk about that push.
We have made a big commitment to invest $26 billion in the next 4 years. And this is after $20.4 billion that we have invested in the last 40 years that we've been in the country that we celebrated last year. As part of this commitment, we want to increase our capacity in the U.S. to 1.2 million from 800 to 900,000 today. And then we want to increase our supply chain, including a steel mill in Louisiana, and then additional investments in technology like robotics, AI, data centers, so on and so forth. But the most important that we have announced during the New York show last week is that we're going to introduce in the market 58 new products. 36 are going to be Hyundai products, and 22 they're going to be Genesis. And then through the next 4 years. And then the most important for us was the introduction of the Boulder concept, because when you look at the behavior and the performance of the brand in America, I think we do pretty much a good job. So we just ended Q1 with an all-time record. We had the 2025 overachieving 1 million wholesales for the first time ever, and we're thinking how we can continue to grow and link this to our commitment to America for America. And we thought that the only segments where we are not competing today are the body on frame. We got a fantastic review by the press, so thank you, Matt. Everybody loved the designs. I can tell you that the reality is going to be better than that. Yep. Our designers never disappoint us.
I will tell viewers who don't know, body on frame means it's a much more robust vehicle. That's a truck, right? As opposed to the unibody cars. And you need that in this region because of all the potholes and broken down roads that take a beating. But it's one that has long been dominated by U.S. players because of this tax. We have a 25% tariff on light-duty trucks built overseas that come in here. Where would you build such a body-on-frame vehicle?
Definitely here in America. This will be part of our strategy to be localized, to be vertically integrated, part of the $26 billion. So we want to make it here with our supplier base and then to the taste of the American consumer.
These, though, I mean, are very long-term plans that you've put in place. So I'm assuming short-term fluctuations in consumer behavior isn't going to change that. But are you seeing changes in consumer behavior now, having to deal here in the U.S. with gasoline above $4 a barrel?
Yeah, we see that all the time. So our strategy is being different to other OEMs in the sense that we want to offer the customers what they want, when they want it. And as such, we not only invested on EVs, but also on hybrids. We're going to start producing hybrids this year in our HMGMA plant in Savannah. And we have also announced that we will introduce EREV, extended range EVs, next year in the country as well. So that's how we came to the conclusion that, if consumers want more EVs, we have to produce more EVs. If they want more hybrids, we have to produce more hybrids. If they want, for example, a Boulder type of vehicles, we will. But to your question, we have seen a significant change in the dynamics. So, for example, in the month of March, we've seen an increase of EV sales of about 40% compared to February. So definitely, when the American consumer sees an increase in fuel prices, they try to move to solutions which are more friendly in terms of cost, right? Yes. Especially in states like California.
We saw today that this administration isn't going to give any help on aluminum and steel tariffs to automakers that produce here. Are you penalized to some extent for producing a car here? Because if you made it in Korea, you might get just a 15% flat tax. And when you build a car here, you've got to pay the 50% on aluminum, 50% tariffs on steel. You've got to pay the tariffs on all of the components that come together. And Ford says they end up actually paying more to build a comparable vehicle than you do when you make it in South Korea.
Well, that's a very good point. That's why, in our case, the strategy is very simple, is localization. And that's why we we are going to produce this boulder with steel made in America. So full integration, the steel, the logistics, the components, the manufacturing, the workers, everything is going to be made in America, including the steel.
I have to ask you about Magma, which is the your answer to AMG or BMW's M. I saw the wingback concept yesterday, which was fantastic. I know you're going to race at Le Mans, which is increasingly becoming like the Davos of car manufacturers. Can you really compete against BMW? Can you compete against Mercedes? Can you compete against Audi with that vehicle here, with that brand here in America?
Without a doubt. So last year we saw an all-time record 82,000 Genesis in this market. And then last year we also achieved our 1 millionth Genesis sales. So we've been the fastest growing luxury OEM globally because we did that in only 9 years and 6 months. So faster than Tesla, faster than other luxury competitors. So, and definitely as a part of the evolution, as a next frontier for our luxury brand, we wanted to get into the competition, so the World Endurance Championship. So you have an open invitation, Matt, to be able to join us in Le Mans. And then it needs to be real. That's why we came up with the Magma Orange and the Magma concept, which if you saw the numbers, a GV60 gives you a standard mode more than 600 horsepower. But if you push the boost motor, so you're going to get to 650 horsepower for about 15 seconds. So this is the Bloomberg boost, or the Matt boost, if you like. 3.4 seconds to make it to 100 miles.
Is F1 next?
That's upon next, yeah. So you can try. So we're going to be credible contender, and it's going to be a real performance.
Constellation Brands reporting their latest earnings in the New York. They are STZ. We're getting fourth quarter earnings for them coming in. Among their brands, of course, Corona Beer and Mondavi Wine. Investors want to see if demand for beer, wine, and spirits is picking up after dragging for the last few years. So here's where we start. Comparable earnings per share for the company coming in $1.90 versus $2.63 year over year. And the estimate had been $1.73, so they did beat that estimate. Comparable net sales coming in at $1.92 billion. That's down 11% year over year. The estimate had been $1.88 billion, so they did beat there. Beer net sales $1.73 billion, an estimate of $1.71. Wine and spirits net sales $194.2 million, estimate of $168.2 million. So quite a beat for them in wine and spirits. The 2027 year forecast is comparable earnings per share coming in at $11.20 to $11.90, and the estimate had been $12.44. So a reminder, the earnings report is the first after Constellation announced February 12th that Nicholas Fink will take over as chief executive officer in April. Coming up next, Federal Reserve officials at their March meeting still expected to lower interest rates this year. We'll take another look at the minutes when we come back. Here are the stories making headlines right now. The CAE will cut about 280 jobs from its global workforce. The flight training company says 180 of those positions will be in Quebec. The move, part of a restructuring, and will include jobs in contracts, procurement, and technical areas. The firm says it has to take several necessary steps to respond to market changes, including soft demand in civil aviation, as well as opportunities in its defense and security segment. Iran's parliamentary speaker says the U.S. has already violated the ceasefire agreement. In a post on X, Mohammed Baher Halibaf says 3 clauses of the proposal have been violated even before negotiations get underway. He cited Israel's continued attacks on Lebanon, the entry of a drone into Iranian space, and the denial of Iran's right to enrich uranium. And he added that a bilateral ceasefire is unreasonable. The ceasefire agreement was only announced last night. Shares of Keyera under pressure today. The Competition Bureau is moving ahead with its investigation into the proposed acquisition of the Canadian natural gas liquids business of Plains All-American Pipeline. Both Keyera and Plains have significant midstream oil and gas operations in Canada, and the watchdog's looking into whether the deal will result in less competition in the industry. The Bureau is also investigating whether the transaction raises barriers for competitors. Shares of Shell ending the day lower after the energy giant says price volatility caused large swings in inventory values. The UK-based company also lowered its first quarter outlook for integrated gas production. Now on the upside, Shell says weaker first quarter gas output and a hit to short-term liquidity would be offset partly by stronger oil trading. The minutes of the last U.S. Fed meeting in March were released today. And in their discussions, even after the Iran war had started, U.S. Fed officials still expected to lower interest rates this year if the job market continued to weaken. Let's go to Vishal Kanduja, Senior Portfolio Manager at Morgan Stanley Investment Management. Thanks for joining us today.
Thanks for having me on, Marella.
So the markets had expected pretty much the Fed to remain on hold for the rest of the year. Are they being more hawkish than the Fed?
Definitely, yes. I think there is a significant disconnect in fixed income markets today, and exacerbated in the last 6 weeks of the conflict as we've gone through. The one side of the market is telling us, which is the rates market, that you will actually need central banks to hike in different parts of the world to slow down growth, which eventually then slows down inflation. So a significant inflation shock. But then on the other side of the fixed income market, which is spread sectors, investment grade, high yield, securitized, these are the spread sectors which reflect a little bit more of growth side of the equation, are unchanged or tighter in spreads. So not pricing in a growth shock. So significant inflation shocks on one end, central banks acting to hike rates is what the market has priced in, but then no growth shock on the other side. So that disconnect to us is inappropriate. And the truth is somewhere in the middle where rates need to readjust down. Yes, there will be a growth shock coming, but the economy is very different. Global economy is very different than 2022. And that's what we heard some of the Fed speak as well through the minutes today, as well as some of the other central bankers who've spoken in the ECB, BOE, et cetera, to slow down those expectations.
I was going to ask, what were your key takeaways from what you saw from the U.S.?
I think the U.S., just to put it in perspective, the meeting was March 18th, 19th. The conflict is still on. Yes, we've announced some ceasefire, but still in the thick of the conflict, the peak uncertainty, if you will, that these central banks met and discussed, looked at the markets, looked at the conflict situation, and then discussed the outlook of their policy. So very clearly, they were coming into it with weaker labor market. I think the last 3 months, 6-month average numbers have been weakening very clearly. And then the other side of their mandate, they are one of the only, if not few, central banks who have to focus on dual mandate. If you will, the other side of their mandate was showing a little bit of uncertainty. So just to put it in a little bit more perspective, last 3-year worth of inflation numbers, you're running a little higher. And then if you put in a supply side shock, so definitely they will try to anchor inflation expectations so they don't get unanchored. So they sounded a lot more hawkish in that meeting. But the minutes do tell you that they were still very focused on the downside from this uncertainty in terms of labor market and growth, rather than just looking at the inflation market. So yes, two-sided at this point, very comfortably in that wait and watch approach, but not as hawkish as what they sounded after the meeting on the 19th of March was our key takeaway at this point.
Let's talk about a couple of other things now that the Iran conflict could be over. There's been skepticism about the return from the increase in AI spending. Do you still see that as positive this year for the American economy?
Absolutely. And I think we see no reason yet for that to slow down. And why I make that statement, Marella, is we've seen about like 240 billion, if I'm not mistaken, over the last like 6 weeks through this conflict of new issues, meaning bond markets pricing in new bonds, meaning new debt being created. Books for those or demand for those bonds were 4 to 6 times over in terms of subscription levels, and spreads are tighter. So there's enough demand, and then there's enough debt being created for investment into the economy in the U.S. So we do think that the channels of economic growth here in the U.S., whether it was the upper end of the K-shaped economy consumer or the AI spending that is going through, has not really budged from that. And then that goes back to the disconnect comment that I made as well. So we do see slower growth. Yes, this conflict, yes, the uncertainty from it is going to deter hiring, deter big investments, but the AI sort of infrastructure spending that is going through and the debt that is being created for it does not tell us anything that is stopping there from that perspective.
Okay, so talk to me about then AI efficiencies and then job losses, because we understand and we know AI will help some of the back rooms for financial institutions, for example, but then we know that could add up to job losses. So how do you factor that in?
So we do think that growth will not be as high or as hot as the last 3 years, so slower growth. And then, yes, job market till now has seen only the cyclical slowdown, meaning lower hiring. Unemployment is not ratcheting up because the labor force is reducing. Part of it is immigration. Part of it is the aging population here in the U.S. We've not yet seen the structural slowdown in the labor market, meaning the structural job losses that you talk about from the AI efficiencies. And we don't think that we will probably see that till the back half of the year, probably the late 2026 into 27 and 28, where you'll start seeing the structural aspect of unemployment rise up from that angle. And that's why we think that the pricing in of hikes or not pricing in cuts from the Federal Reserve perspective, even at this positive growth scenario in the U.S., is incorrect. So you should expect that the curve should steepen, meaning bull steepen, the front end should start pricing in some more cuts from the Federal Reserve because of these structural job losses that we expect over the next 18 to 24 months when we start seeing this a little bit more in the economy.
Okay, I do have to leave it there, sir. Vishal Kandusha is Senior Portfolio Manager, Morgan Stanley Investment Management. Thanks for your time. Up next, we'll speak with Ian Bremner. He's president founder of Eurasia Group, talking about the implications after the U.S. and Iran agreed to a 2-week ceasefire. Back in a moment. There is a ceasefire in place in the Middle East, but already accusations about it being violated. Let's go to Ian Bremner on this, president and founder of Eurasia Group. Ian, thanks for joining us today.
Sure.
Less than 24 hours in and already 3 allegations by Iran. Do you think this ceasefire will hold?
I don't know. I think that it is a meaningful change in trajectory for the war than we were in yesterday. The baseline is that the United States started the war. In terms of the war goals, in terms of the trajectory. And so the fact that President Trump has decided that he's now going to frame this as a success and de-escalate and talk about a new regime that he can engage with, that provides a significant reduction in the risk of further escalation. That does not mean that we're home free in terms of the Strait opening or no more war in the region, or the Israelis and the Emiratis and the rest all, agreeing with, engaging with peace with Iran and Iran's proxies in the region. So there's a lot of uncertainty here. But the most uncertain piece of all of this from day one of the war has been what President Trump is going to do. And he's created more certainty in a climb down in the last 24 hours.
Okay. Has he, though? Because he's basically saying what those 10 points are. Yeah, there are bases for negotiation, but some of them have been a clear red line for Washington in the past, like the uranium enrichment. And now that's part of that 10-point plan that Iran has put forward.
Well, the question is, to what extent are there red lines that come from individual points in the deal, Or is the real change the fact that Trump is prepared to accept de-escalation? Because, as you know, President Trump is the one pushing and deciding all of these individual moves, not the members of his cabinet, not the Israeli prime minister. It's Trump. And he has been very, very inconsistent in the goals that he has been setting. He has said before there has to be regime change. Now he's saying there's already a new regime. The Iranian people obviously don't agree with that, but it doesn't matter. From Trump's perspective, he said he's won. Now, if Trump says that there can't be any tolls being taken, it has to be fully open, that's probably not going to happen. On the other hand, Trump has also said it's okay for them to take tolls because we can do a joint venture on it, and that's better for the Americans. It'll leave others out. Which one of those reflects where Trump actually wants to be? The answer is we don't know, but we do know that Trump is now embracing de-escalation. He's saying that he has won. So he is now invested in a solution that doesn't involve further war. He can change his mind. Lots of troops are still coming into the region, but for now, there's greater predictability, and I think the markets are reacting to that.
Wouldn't it be a show of faith then to stop those troops from advancing forward or putting more troops into the region if he wants that ceasefire to have a chance?
That's an interesting question. If he already has an agreement from the Iranians on a ceasefire, and they haven't given up anything particularly for it. I mean, they're not yet saying that they're prepared to stop enrichment, all civilian enrichment. And they're certainly not saying we're going to give up control over the strait. Then I can see why President Trump would want to continue to have the military optionality to say that, well, if this breaks down, I'm then going to have my troops in place. By the way, part of the reason why I think he accepted a 2-week ceasefire is because his own military advisors have been telling him in the past days, we're not ready for ground forces. The Iranians have more ballistic missile capacity than they had expected, than they had prepared for. They have more capacity to dig those missiles out even after the launch sites have been hit. They have far more ability to launch drones, and they have more advanced missiles that can even get through defenses when the Iranians are telling you in advance that they're going to hit a certain target and harden target, like we saw with the LNG capabilities in Qatar, and they can't be knocked down. So until you get at all of that, the U.S. does not want to be telling Trump, OK, we can now take these forces deployed and use them on the ground. So an extra 2 weeks from that perspective is not the worst thing for Trump's military advisor.
OK, that being said, then do you think it's just a stalling tactic?
No. Again, from the beginning, I do believe that Trump understands that this war is very unpopular. It is costing him a lot economically. It is costing him at the polls. Midterm elections are coming up. He was looking for an excuse to climb down. Frankly, he probably should have done this 4 weeks ago. It's not as if the Iranian position has changed all that much in the last month, but he wasn't prepared to do it. The greater pain and the fact that the Iranians have shown they are willing to take that pain while giving economic disruptions effectively to the rest of the world and the United States, that's what led him to back down. Having backed down, we have a new baseline. Trump frequently keys on his own previous statements, his own actions, but he also holds a grudge. You've seen on NATO that Trump said, well, this really came from Greenland. That's how it all started. He lost on Greenland. He was embarrassed on Greenland. He had to back down. He still holds a grudge on that. You do have to worry and wonder over the next 3, 6 months, 2, 3 years, Trump's still president, if it turns out that he accepts a deal that makes him look bad on Iran, I don't think this is the last bite of that apple that Trump will ever have.
Okay, because this is, I'm going to say tenuous, what would it take for Trump to pull it back? Would it be the Strait of Hormuz doesn't reopen freely within a matter of days?
Well, the Strait, I think there's a big question of how much the Iranians are willing and capable of doing more deals that get further numbers of tankers through so that we then see energy prices come down. Because, of course, Trump as a president, short-term is more sensitive to the sort of things that you all focus on your show, which, these market moves and, sentiment and oil prices, all the rest. He's very, very focused on that. And he's watching that real time in a way that a lot of the other information that gets to Trump is it's sanitized by his own people to make it seem more favorable to things that he's doing and to how brilliant his decisions are. So I think that's going to be a big component of it, of to what extent the markets buy all of this, they get on board with what he's been saying, and do we see more ships go through the strait? I think that actually matters.
Okay, so obviously the market liked it a lot today. We'll see if they do.
They liked it a lot today.
They liked it a lot today, but that's today.
Trump is going to be more enthusiastic about it as a consequence of that. So there you go. You're giving him some feedback.
Well, there you go. Close loop, because I don't know if he's going to respond to that or he changes his mind within the hour. Ian Bremmer, president, founder of Eurasia Group. Thank you, sir. Appreciate it.
Good to see you.
Longtime Conservative MP Marilyn Gladue crossing the floor to the Liberals, putting Prime Minister Mark Carney's government now just a single seat shy of a majority. CTV's Graham Richardson has more.
Because of Marilyn Gladue, a Conservative MP.
Here's Marilyn Gladue as a Conservative back in 2023.
Our leader has been supportive of this bill all the way along. I want to thank him for that.
It is a great pleasure.
Cut to today.
I'm very happy to be the newest member of our new Liberal government.
A partisan defection that enrages Conservatives as the Prime Minister casts it as a country coming together to his side.
This all comes at a time when the country as a whole is uniting to move forward, and it's important that over there we unite to move forward as well.
Pierre Poilievre tweeted, Gladue said that floor crossers should face voters in a by-election. I could not agree more. As recently as January, she told her local paper, we elected you under this banner, and if you don't want to be under that banner, then we deserve a chance to have a redo of the election. Sarnia is a border town that's known for oil refineries and some manufacturing connected to the auto sector. Some constituents here are not happy.
We thought absolutely no way would she cross. So now I'm wondering, why did she cross? What did Carney give her? And explain it to your constituents.
Most Conservatives felt that way today, that Gladue would be the last to make a move like this.
Look at her social media feed. Up until just hours ago, she was trashing and attacking the Liberal government of which she's now proudly a part. This is very cynical and it's very odd.
But the red clothing at the photo op and broad smiles right inside the Prime Minister's office, another body blow to Tories. So is this over? Don't bet on it. The party is about to start for Liberals. Their convention in Montreal begins tomorrow. So far, there have been no floor crossers from the province of Quebec, despite rumors swirling around this place for months. Graham Richardson, CTV News, Ottawa.
Coming up, hot picks. We'll zero in on three plays in the telecom sector when we come back. Time now for hot picks, and we zeroed in on three plays in the telecom sector. We were joined by David McFadgen, Managing Director in Institutional Equity Research at ATB Cormark Capital Markets.
It's my favorite name in the telecom space. So when I think about Quebecor, I kind of go back to what the company did in 2005 in the cable telephony market. So it entered that market from zero, and it came in with a low-priced landline telephony, cable telephony product. I think it was around $30 at the time. And Bell's ARPU was around 50, so that was its main competitor. And there wasn't really a lot that Bell could do because it didn't want to reprice its sub-base. Tried to compete on bundling, marketing, reinforcing the brand, but there wasn't really a lot it could do. Flash forward 10 years, and then Quebecor had 1.35 million landline telephony subscribers, generating over $200 million of EBITDA. So obviously very successful. I mean, it's since come off just due to the wireless substitution going on in the market, but clearly very successful there. So when I think about that, it kind of reminds me of what they're doing right now. So they've purchased Freedom. They're coming in the market with a very compelling product. So they're including roaming in all their plans. And so they're hitting the incumbents where it hurts. So the incumbents, right before COVID, used to do about $400 to $500 million a year in roaming revenue, very high margin revenue, by the way. And so by including roaming in all their plans, Canadians can travel the world. They don't have to worry about sticker shock when they come back in terms of a high bill. And so it's very appealing. And the incumbents, they don't want to match, because who wants to see $400 to $500 million of revenue disappear, right? That's high margin. So Quebecor is doing very well. It's gaining share, and it's continuing to take share. And I expect that that's going to be the situation for many years to come.
You do also favor Rogers. Partly, you do see strong growth from that massive Shaw acquisition.
Well, I mean, Rogers, so all these guys, maybe with the exception of Quebecor, are looking for low single-digit organic growth. But what's appealing to me for Rogers is, so if you value the core business at around 7 times EBITDA, and you give zero value to the sports assets, then you get a target of around $50, which is kind of close to where the stock is trading, right? So the market's saying the sports assets aren't worth anything, if you look at it that way. Clearly, those sports assets are worth many billions of dollars. So we're valuing the sports assets at $11 billion, so $9.5 billion for the 75 interest in MLSE, and then $1.5 billion for the Jays and the other assets there. So if you give that value, then you get a target of where I get it is 74. It's obviously a very high target compared to where the stock's trading, but there's an event coming. They're going to buy out the 25% interest from Kilmer, so they're going to own 100% of MLSE. Then they're going to combine MLSE with the Jays, and then they're going to sell a minority stake in that. And so I think when you see a third-party independent player come in and put a value on those sports assets, put a marker on those sports assets, the stock is going to rally, because now we have an independent valuation confirmation, and the stock is very cheap. If you look at the multiple, it's trading around mid-6 times EBITDA, but it's actually cheaper than that because the sports assets don't really generate any EBITDA, right? So I think there's an event coming. It's going to happen this year, probably. Well, they're going to buy out some of this year. I think they'll probably do the minority stake this year as well on the combined assets. So there's an event coming here, and I think it will show that there is truly a lot of value in those sports assets, and the stock is really undervalued, in my opinion.
And then finally, BCE, the parent of this network, you think that stock is attractive. Why? I mean, given that there are concerns about price cutting in the wireless industry, why would you be a buy on BCE?
So I'd buy the other two first, but no, I like BCE. I think it's a very stable company. They've right-sized the dividend, so I think the dividend should be safe. They're focused on AI, clearly. Their goal is to generate $2 billion a year in revenue from AI by 2028. They did a deal recently in Saskatchewan. It's going to add a lot of, the forecast is $500 million in revenue out of that. So, I see a stable company, low growth, but stable, solid dividend. But yeah, so we like it, but I like Quebecor and Rogers more, but I do like BCE to recommend.
And just very finally, before we let you go, we're tight for time. What about TELUS? Do you favor TELUS right now?
No, I don't recommend TELUS. I think people are worried about the dividend. If I was the new CEO coming in, I'd probably cut it. I'm not saying they're going to cut it, but that's what I would do. Just because their payout ratio is over 100%. If they sell a minority interest in TELUS Health, then they're even more offside because now they can't access the free cash flow of TELUS Health. So, I'm not a fan of TELUS right now.
David McFadgen is ATB Cormark Capital Market. Let's get a final look at how we ended the day today in the North American markets. TSX up 1.2% or 383 points on the day. The S&P gaining 2.5%, and the Nasdaq up 2.8% on news of that ceasefire in the Middle East. We'll see how long it holds. A quick look at oil, which went in the opposite direction, of course. West Texas Intermediate for May down 16.43 to 96.56. That does it for the close today. Thanks very much for joining us. We'll see you tomorrow.